decline ratio. The small cap index is down a little more forceful straight off the bat. I mean, 0.5% down on the small cap index, a quarter down on the Nifty, on the mid cap index. Adani is up 1, Reliance is higher, ITC, Grasim, Nestle, some of the Nifty names. The heat map up on your screen, and it's more down than up, or maybe it's evenly matched at this point. So stocks are opening up, and I think in the broader space there will be more action. Surabhi.
Okay, well, on Hindalco, Nigel's spot on. I mean, it seems the market's looking at some bargains. Stock was beaten down yesterday as well, and the Novelis performance was largely known. So full marks to Nigel on that one. Apart from Hindalco, Adani Enterprises is a second best performing stock on the Nifty. Grasim's numbers are being well received, or okay received by the market, 1.5% up. Bajaj Finance is seeing some gains, some buying on heavyweights like ITC, Infosys, Reliance and Lever. Because of these four, we're not seeing a wider cut. Some of the banks like SBI are also trying to contribute, at least for the time being. But it is getting a little tough out there. 43 points now lower on the Nifty. Bank Nifty is the one that's down a little more, down about 200 points there. Eicher Motors, the disappointment on the margins is very, very evident. 5% down on that stock. Apollo Hospitals, despite a pretty steady quarter, stocks down 2%. Tata Motors, M&M, these are some of the other names that are losing ground. And the big culprit of the morning, you can say, is HDFC Bank. That's the biggie, which is taking it down. Then there's Kotak Mahindra as well. So, yeah, little all over the place on the Nifty right now. But the bias is negative.
Well, that's right. The bias is negative, and also the advanced decline ratio has moved firmly in favor of the number of stocks declining. You have 1,500 stocks that are declining. To run you through a few names that dispute with regard to the brand name out there. Tilak Nagar Industries, yesterday down 20%, today down another 5%. We'll wait for some clarification from the management, whether or not there is something and what's the way ahead from here on. So that's down 5%. Zaggle Prepaid, second day running, the stock is down, close to around 10%. Big selling is what we're seeing out there. ITC Hotels, yesterday actually it was an outperformer. It ended high with a gain of around 3%. Today it's pulling back a little bit. Transrail Lighting, that's the positive reaction that we're getting today. It's up close to around 2.5%. So good move out there. Transrail Lighting should come up for you on the screen. Nalco, we told you the numbers were good. However, is this the peak quarter? That's going to be important. So Nalco, in fact, is up close to around 3% as we speak. We'll get the management in just a while from now. But otherwise, you'll have to see on the Nifty till that 23,300 mark is held out, at least for today's trading session. The bulls will be trying to fight back. We'll have to see how that plays out. But the breadth of the market is a little bit concerning yet again.
3:1, I mean, on the downside. So 3 stocks down for every 1 stock which is higher. Some of these super performing stocks, look at something like an HBL, erstwhile HBL Power. It's down 8%, 487 on very, very large volumes. It's the third largest traded name on the NSE right now. And otherwise doesn't show. Okay, it's HBL Engines is, I think, the name of the stock. Yeah, 7%, that's the one. So 491. There's Zaggle, of course, Nigel mentioned. Tilak Nagar, we highlighted, so 5.5 lower. Escorts is down 5%. Newland is down 6%. Anandraj is down 4%. And EPAC Durables is down about 4%. PNC Infra is down 3%. Sagility is down 4%. And of course, I mean, Eicher is down about 6.5% right now. So a lot more stuff happening on the downside. Dreamfolks, which is the airport's the lounge operator, is down about 6%. Recent listing 319 on Dreamfolks coming in at this point of time. So it's about 4:1 now in terms of the declines to advances ratio. Transrail, which reported numbers, is up 2%, is the second largest volume traded gainer. And of course, Nalco, you'll hear from the management in about 10 minutes from now, is the other one which we will sort of focus on. But let's welcome in Pankaj Murarka, who's now with us. He's a veteran, seen many cycles, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. Intense debate on at least social media on what to do with small and mid caps. I'm sure. I don't know if you followed all of it, but I'm sure it's kind of tough to miss. What is your sense? I mean, I think generally everyone is in agreement that maybe things got overdone quite a bit on the upside, and now, of course, many stocks are paying the price, but it's always like that. But what is your sense from here, Pankaj? Because markets look ahead, trying to price in what's coming 3-6 months down the line, not look back. So that's the question to you.
Morning, Prashant. Well, Prashant, we need to acknowledge or concede the fact that we are 5 years into this bull market. After 5 years, you don't get low-hanging fruits. And if you have a ferocious bull market like the one we've had in the last 5 years, obviously there will be pockets of excesses. And this time around, we have had excesses across the board, and largely more than we've had our excesses in mid and small caps. So I think we're going through a process of mean reversion, but which is classical of any market cycle in that sense. I think over the last 8 or 10 weeks, we have seen meaningful, mean reversion or pullbacks in prices, especially in mid and small cap. It's been slightly more amplified in that sense. I think the challenge, if you ask from my point of view, is more on the small cap side than on the mid cap side, because one, valuations are pretty rich there. And more importantly, what concerns me more is there are a lot of companies with, where business models are untested for economic cycles, economic crises. They have fragile business models, and markets have given them valuations which certainly do not tie with their long-term growth prospects. Markets probably are assigning multiples basis currently growth over the next 2 or 4 quarters, and we know that the long-term growth for a lot of these companies will be much lower. And in many cases, the business models, as I said, are untested. And when you markets go to that extreme in terms of giving high multiples or high valuations to those kind of companies, obviously there'll be some pain there. Having said that, I'm not so negative on an aggregate basis if you take a 1-year view, because I still think there what will make money from here on is bottom-up stock picking. So if investors are focused, there are still enough ideas there on a bottom-up basis where one can go out and invest and still make reasonable or healthy returns over a 1 year to 3 year time horizon kind of thing.
By the way, I just want to point out Eicher once again. The pressure is unrelenting on Eicher Motors, almost 6% down. And you would argue what's so wrong, because the top line was more or less in line with estimates. It was not too far off. But the margin fell a little more than what the street had penciled in. The margin year on year is down almost 200 basis points, 190 basis points to be precise for Eicher Motors. And the street just doesn't like that. Plus, there's no price increase either. So it seems that, that's the reason behind the punishment the stock is getting today. Pankaj, great to be speaking with you this morning. Good to have you on the show. So, thinking of Eicher, I was just wondering, how does one play the consumption bonanza that came through in the budget? And I think the consensus that we got was that it will be rather spent on discretionary items than sabun and tel, so to speak, right? What's your thesis around it? So, when you find, whether it's autos or home improvement or even, leisure and hospitality, would these be some pockets that you would look at?
I think consumer durable looks more better place to be benefiting out of the tax rebates that the government has rolled out in that sense. And I'm hoping that some part of that will certainly trickle down to staples as well. The fact is that we are in the middle of a sharp consumption slowdown. Rural consumption has been slow or sluggish now for almost 7 quarters. Urban consumption has been slow for almost 4 quarters. A lot of meaning something like apparels, a lot of broad categories have seen negative growth or very modest growth in that sense in the last 4 or 6 quarters. Apparels have had a negative growth, organized apparel, which is pretty surprising because we don't see negative growth in apparel so often. So I think from the overall landscape, probably consumer durable is one segment which looks like, should be a beneficiary of that probably in the second half of this year as we see revival in the consumption. And I also think that we'll see some recovery in staples as well, because the growth or volume growth in staples have been very modest over the last 3 years. But probably now income levels should catch up with the sharp rise in inflation that we have seen in the last 3 years, and we should see some recovery in staples as well.
Just on consumption, a follow-up. What kind of a multiple would you be willing to give to some of these consumer platforms / internet companies, right? The Swiggies and Zomatos of the world. And I mean, you spoke about retail. I could also ask you about Trent, which was the poster boy. I mean, consumption stock, a retail stock trading at 90 times, 100 times forward earnings. But so much has changed over there as well. So, any other pockets of discretionary that you would consider where maybe stock prices are coming now more in sync with reality?
Yeah, so on the platform companies or the new age companies, I think the challenge there, valuation is not, they will always be priced richly because markets would look at longer term value because it's a space where winner takes it all. So, and generally in every in the internet space, generally the trend is that the top 2 or 3 companies makes 120 or 150% of industry profits because all the other players lose money. So the nature of the business itself leads it to a oligopoly kind of a structure. The point is with some of these companies that we have seen pullback is we are seeing a much heightened competitive intensity in that sense, whether it's in quick commerce with some of the incumbents trying to make a comeback, or in fashion and beauty, where some of the larger players or omnipresent retailers are heightening the competitive intensity. So I think the issue there is about competitive intensity, then about longer term valuations in that sense. Coming back to in terms of profits, as I said, durables at this point of time looks better placed in terms of growth. So we like some of those companies, including likes of Havels or within mid caps, something like a Crompton Consumer. I still think I agree with you that probably we should see a recovery in discretionary. The growth recovery in discretionary should be much better than staples. So we own names like Jubilant Foods, which we think should be a beneficiary as and when consumption revival happens, or United Spirits, which should again benefit from the revival in discretionary consumption in that sense. So we are focused more on urban consumption, and within that urban discretionary consumption, we think that will see a faster recovery versus some of the other categories.
Okay, Jubilant Food and United Spirits. I think we must have contributed to the sales for these two companies at some point, most of us for sure. Nigel.
Well, Pankaj, I wanted your view actually on the top 2 Nifty losers right now. In Eicher Motors, that's down close to around 5% as we speak, and Apollo Hospitals as well as reacting to its numbers. I don't know whether, a new entrant into the hospital space, we had the news about the Adani Group making its entry out there, whether that's weighing on to sentiment as well. And that's why that name is now down close to 5%. Any view on either of these two names? Well-run franchises, some kind of softness in their numbers, but in the past they've delivered good numbers. Your take?
Well, as far as Eicher is concerned, I think the numbers are pretty healthy in that sense. So one trend which is becoming visible, Nigel, as we saw in the case of Trent as well, what we were alluding to, is probably while companies are reporting pretty healthy numbers, but probably the growth expectations that's priced into the stock is much higher. So when the Trent stock corrects, even after a 32% EBITDA growth, which essentially reflect that the stock was pricing in much higher growth at about 40% plus. So probably a 32% growth in that sense didn't sound so great to the street in the context of expectation that were priced in. I think the similar case with Eicher or with Apollo in that sense. So obviously, all of these stocks have done phenomenally well over the last year or couple of years in that sense. So I think it's more of a pullback than anything, or than poor numbers in that sense.
Pankaj, just very quickly, I remember you liked SBI, right? You still like SBI, I think. Numbers from PSU banks have all been pristine as compared to private sector players. But stocks are, is it the broader market mood or is something wrong here? PSBs.
Well, within the state-owned banks, obviously we own SBI. We've liked it for a very long time now. I still think that the inherent value of the implied value of the franchise is much higher than what market is pricing, and at some point of time, market will take cognizance of that. I think this quarter's numbers have been pretty good for all of these banks, and especially for SBI, has been a pretty decent set of numbers. More importantly, valuations are pretty reasonable, and the growth outlook continues to remain reasonably healthy. I think financials within the overall market is one sector, and especially lending-oriented financials, where valuations are far more reasonable as compared to other pockets of the market. The sector, financial sector, is one of those segments of the market which is trading at almost about 25-30% discount to the Nifty index. And the sector has underperformed in the last 3 years. Asset quality is pretty strong. Hopefully, meaning loan growth should pick up going forward from the second half of next year, and that should improve the growth trajectory of these companies. So probably, I think private sector financials should do well, and within that, SBI or some of the other private sector names like HDFC Bank or Kotak Bank, which have been laggard for a while, should certainly catch up.
Okay. All right, Pankaj, got that point. Thank you very much for joining us on the show today. Good to get that perspective and advice from you. By the way, just a quick check on the screen and look at this. This is a repeat of yesterday playing out all over again. Look at the mid-cap market now. Large caps are okay. This is not the problem. Nifty is only down 70 points, which is still fine. the mid-cap market has again started dealing with a fair amount of stress. Over 1% down on the mid-cap index, 1.3% to be precise. And you're again so early in the morning, nearing that level where there are 2,000 stocks declining and less than 400 stocks advancing. So really, really painful on the mid-cap screen. Just some names: Agility, Newland, Varroc is down 6%, KPI Green 5%, Zaggle is down 9%, EPAC Durables, long list out there. So plenty of pain in the broader markets.
Well, that's right. Plenty of pain in the broader markets. And on the headline index, you don't want this mark to break decisively. We've been making this point, 23,250 to around 23,300. Very, very crucial that we defend this mark. It's because the 20 DMA comes in out here. And even in yesterday's trading session, we went down to here. So crucial to defend this and also keep an eye out on the broader markets because a lot of stocks are seeing quite a bit of selling pressure. Let's see whether some of them get bought into. But let's talk about good things. And one stock that delivered a very, very good set of numbers and probably the best quarterly performance that we have seen from their end is Nalco. The numbers were good. The problem is, what's the way ahead from here on? To help us out with that, we're joined by Mr. Brijender Pratap Singh, the Chairman cum Managing Director of the company. Hi, Mr. Singh. Good morning. Thanks a lot for speaking to us here on CNBC TV18, and we look forward to speaking to you more often. Well, congratulations on a solid showing in the past quarter. However, now the street is a little bit, sketchy. What's going to happen to prices from here on, given that President Trump is putting in some tariffs out there, and even we have seen pricing has pulled back. What is your estimates on alumina as well as aluminium prices from here on?
As far as alumina prices is concerned, alumina prices in October somewhere it rose to around $800. And now it has come down to around $500. That was a seasonal sort of thing because of some production cut in Australia and also New Guinea issues of production from export from New Guinea. Now the production of Australia has started. So the pressure on alumina prices will be there in the coming time. It has dropped down to around $500, $530. And in the coming time, it can further drop. Maybe around same level it can retain also. But as far as aluminium prices are concerned, LME, the forecast for this quarter is around $2,575, and throughout the year it was around the same, and the next year it is around maybe 26 is the forecast. But after this declaration of the tariff, the pressure will be there on the prices because whatever imports which is going into the US market, the surplus of aluminium will be available in the market, which may come to the other markets. There can be another effect also because in US, there are some of the smelters which are not working. Those smelters can start. Otherwise, the price pressure will be there, aluminium price in the US market. So demand can go down in the US. That can be also happen. Or maybe some smelters can start and overall production will start in the US. That will require more and more alumina also. So some requirement of alumina can go up. So it will all depend on what will be the smelter operation in the US and what will be the demand and consumption requirement in the US.
All right. So as things look as of now, you'll be working with the base case for alumina around $500 per ton and aluminium around $2,500 per ton. Should that be fair?
Aluminium will be around maybe 25.70 we are expecting. That should be quarter. In the next year, financial after March, maybe it can drop down by around maybe $20-30. But maybe around 2070, 25.70 will be that. And alumina will be around maybe 500 plus minus 10-20.
Got it. Okay, so we have got the pricing equation out of the way. The problem is the street is appreciating the past quarter's numbers, but they know because of the fall in alumina prices, well, the profitability will not be as good as what we saw in quarter 3. Let's talk about the cost element then. Captive coal is something that you have been gaining on. So could you tell us what is the captive coal benefit that you're seeing in quantity terms as well as in cost savings for FY25? And for FY26, how much higher will that go? Because then you'll have both the blocks that will be on stream. So the coal saving will be higher. Please go ahead, sir.
As far as our captive coal is concerned, our total coal requirement is around 7 million ton, out of which around 3.54 million ton we are taking from the linkage coal, and around 3 million ton was from e-auction coal. The e-auction coal, earlier years, the prices were on the higher side. Now the e-auction coal prices have also gone down. But the difference between the cost of our captive coal and the e-auction coal still remains to be around 400 to 500 rupees per ton. That is the kind of difference we will be having. So that will account for the saving of around maybe in the next year, financial year, our captive coal production, which is this year it will be around 2.5 to 3 million ton, will increase to 4 million ton next year. So our e-auction will be zero, not taking any e-auction coal, only linkages coal will be taking, and some amount of linkage coal also will be reducing. So we will be saving maybe around 150 to 200 crores on that in the next year.
Okay, 150 to 200 crores additional in FY26 in comparison to FY25?
Not in addition to, if you talk about FY25, that will be around maybe 120 crores.
Okay, 120 crores. Okay, got it. All right.
2 million ton. Next year we'll be doing around 4 million ton.
Got it. All right. What about if you could tell us the progress on the 1 million ton alumina, the expansion that you were talking about? Does that come on stream in sometime in FY26? Give us a timeline of that. And how much money has been spent and how much more will you spend?
As far as this alumina refinery, fifth stream refinery is concerned, around 70% of the physical progress job is over. Our target is to start in the September, maybe 1 month or 2 months here and there. Maybe we'll be starting in the third quarter of this year. As far as the total project cost is concerned, the total project cost was around 5,700 crores on almost 37 already we have spent in, and the major payments will be coming in this year, around 1,500 to 2,000 crores. So we will be adding around 1 million ton alumina production once it comes. Maybe this financial year we'll be having around maybe 2-3 lakh tons only, and next financial year means FY26 we'll be having around 2 or 3 lakhs because we'll be starting in the third quarter. And in the next financial year, that is FY27, we'll be adding up around 1 million ton extra alumina production.
Okay, all right. Final question, sir, before we let you go. Margins in the past quarter were close to 50%. That's much higher than what we've seen in the past. Going by the cost saving, going by the current prices, what kind of an EBITDA margin should we be looking at?
If this quarter, if you're talking about quarter 4 EBITDA margin, we have already, if we see the jump in the margin, it was around 161% jump in the margin as compared to 9 month if we compare to previous year. And out of that, around 62-63% jump in the EBITDA margin was due to the revenues, and around 99% of the jump in the margin was due to our cost saving and operational expenditures. So our present EBITDA margin, which is around this quarter, was around 44%. It will go down slightly, and maybe we will be ending the year at around maybe 25 to 30%.
Margins are sustainable at 25-30%. Very quickly, what is the current cash in your books?
Cash around 4,000 crores.
4,000 crores. It's been a pleasure talking to you, sir. Thanks a lot for joining in. You've given us a fair estimate about how you see things panning out. We re-invite you in a couple of weeks or a couple of months to, give us an update about how things are progressing on ground. Thanks a lot for speaking to us here on CNBC-TV18. Well, time to slip into a short break. On the other side, we'll have the management of Apollo Hospitals who will be joining in to help us out with their quarter 3 earnings. Stay with us.
Welcome back. We continue with our corporate conversations. Apollo Hospitals is the next company on the radar. Now, Apollo reported a pretty good set of numbers for the third quarter. EBITDA margin improved by about 110 basis points. Revenue was in line with estimates as well. And most of the businesses of the company have grown between the 13 to 15% range. To talk about the way forward, we have with us Ms. Sunita Reddy, Managing Director at Apollo Hospitals. Ms. Reddy, always a pleasure to have you on the program. Thanks so much. It's been another good quarter for Apollo Hospitals. But before we dive into the numbers and the details, I think the buzz on the street is, I can't even say new kid on the block because it's a very large business conglomerate that seems to be getting into healthcare now. The Adani foray, the Adani entry, along with Mayo Clinic at that. What are your thoughts on, whether the market is big enough or not? But what does it typically do when large conglomerates enter the space? Of course, it's good for patients, but what does it mean for business?
Well, I think it's good for business as well, because you see that, first of all, the structural demand that gap is still very large. The second is a validation that these type of hospitals, this format is the right thing to do, which is why people like Adani are entering the business. There's huge potential also for India to attract international patients from across, especially from our neighboring countries. And if you look at Adani's location in Bombay at the airport, I think he's really tapping into the potential of international patients coming to Bombay.
Okay, you're of course, being very, very gracious as you always are. So it will be good for perhaps a lot of the international patients looking at Bombay as a destination. But again, I mean, just to press on that point, does it, in the cities in which we have such a large launch happening, with more beds coming in, and I think they're talking about, 1,000 beds, does it drive down pricing in any way whatsoever, or is the demand way too much for it to make any dent on things like pricing?
So Bombay, as we studied it, is a 70,000 crore market. I am sure there's space for many providers to do well. And, if you look at the way the city is growing, definitely huge opportunity. And 1,000 beds, I have to say that Apollo thinks differently, because we've been cutting down our ALOS almost every year, which shows that even with the 400 bed or 450 bed capacity, we're able to do really good revenues. And if you look at our performance this quarter, with 68% occupancy and a reduction of ALOS by 1%, we've actually created additional capacity of 160 beds.
The demand for healthcare, of course, absolutely exploding, and quality healthcare. Ma'am, thanks very much for joining us. Good morning, Prashant here. So let's just talk about the numbers. Revenue growth has been 15% on a year-on-year basis. What was the mix this time that led to a 8% increase in average revenue per occupied bed? It's just under 61,000 rupees. And what is the guidance here going forward? This quarter, Jan to March, and ahead as well.
So the ARPOB really grew because of our Congo mix. There was a 10% increase in volumes for Congo, which is cardiac, oncology, orthopedics, neuro, and gastro. These grew really well, and this resulted in the increased ARPOB. So if you look at total growth of 8% came from ARPOB, and the balance 5 from volumes.
8 from ARPOB and 5 from volumes. That's how it breaks up.
Yes.
Okay. All right. And on the ARPOB side, what can we expect going forward, in your opinion?
We had said earlier that for this year, 8% growth is really good growth, especially because we've calibrated case mix really well. A slight tariff improvement has also added to that.
So ma'am, is the 60,000 mark for ARPOB sustainable? What are the trends that you're seeing so far in the fourth quarter? By the time we exit FY25, will ARPOB, sustainably be above 60,000?
It could be above 60,000 because in metros it's around 70,000, and ours is also present in Tier 2. But clearly, this is a very sustainable ARPOB that can grow at 4%, continue to go even by another 4 to 5% going forward.
Hi, good morning, ma'am. Good to see you in. What about Apollo Healthco? Out there it's shown a good revenue growth, I think of mid-teens, and also margin improvement is what we've seen out there. What's the outlook on this business?
So if you look at Apollo Healthco, revenues came in at 2,352 crores, representing 15% growth. But more importantly, the company turned profitable with 32 crores of profit. And going forward, we're seeing increased by 25%. We have 7.9 lakh users, and that increase in utilization is really driving both revenue and profitability.
Okay, and what about Apollo 24/7? The GMV, I think we were looking at was around 4,000 crores, is what you briefly mentioned. Is that on track?
We're not on track for 4,000, but clearly our GMV at 760 crores represents an 11% increase. But more importantly, I think we need to calibrate growth with profitability. And this is the strategy that Apollo will employ, that growth is important, but profitability is required.
Okay, so you end the year then at what? If not 4,000 crores, should it be in that vicinity of around 3 to 3,500 crores, since you've already done nearly around 800 crores in the past quarter?
Yes, yes.
Ms. Reddy, speaking of profitability, I'm looking at Apollo Health and Lifestyle, and there at the net level, of course, losses have reduced quite a bit from 14 crores. The losses down to about 8 crores. When do you break even at the net level for Apollo Health and Lifestyle?
Next year's first quarter, we should break even. We are really driving the diagnostic business with a 15% margin. And I'm sure that we are ready to scale it. We've set up global reference labs that really has a very high-end test menu, which will give us better margins. With this, we should be able to achieve profitability next year by the second quarter.
Okay, so that's important. Break even by maybe Q1 of FY26 and moving towards sustainable margins of 15% in Apollo Health and Lifestyle. So got that. That's an important headline. On the other one, Apollo Healthco, where the margin right now is 2.4%. What's the scalability there on the margin profile?
I think in 3 years, they should reach 7%. Let's not forget that a large part of the revenue is coming from the offline pharmacy, where the margin is 7.7%. So they do have a huge growth plan to increase the number of pharmacies. Currently, they have 6,320 pharmacies. They've added 120 pharmacies, and there's a strong 7.7% margin. So over a period of 3 years, you can expect to see a consolidated margin for the business of 7%.
Okay. Finally, before we let you go, ma'am, just an update on the corporate merger that's underway, the integration of Kaimed Private Limited. On that whole corporate restructuring piece, where exactly are things now?
We're going according to schedule. And that's why I said, watch out for our third year. Hopefully, everything will fall into place. The integration should happen by then.
So that's in year 3, you're saying?
I'm saying it should be completed by year.
Okay. All right, Ms. Reddy, we'll leave it on that note. Thank you very much for joining in and giving us perspective on the business, as well as the entry of a new player in the healthcare space with Adani announcing their plans. Well, with that, just a quick check on the markets once again. Things have kind of stabilized to an extent. The Nifty decline has been arrested for now. The cut is just about 0.2%. And even for mid-caps, at one point in time, it was looking like a deeper gash. But now the mid-cap index is also pulled back a little bit. The cut is about 1%. Okay, 1.4%. Maybe I need to refresh my screen then. All right. It's still a little painful.
No, actually,
for the mid-cap space.
It's lower than that. I think there has been a bit of a recovery. The mid-cap index, that's correct what you're saying. It's recovered,
1%.
It's recovered 0.5% from the day's low.
Okay, all right. On that note, let's quickly move on. And Nykaa is the next management on the show. The company reported a stellar set of numbers for the third quarters. Profit jumped by 51%. EBITDA grew by more than 42%. To talk about this, we have Ms. Falguni Nair, founder and CEO of Nykaa, with us. Ms. Nair, thanks so much. It's been a really great quarter and a all-round improvement across parameters in a tough consumer environment where lots of companies are struggling. So you tell us, what are the categories that have led to this outperformance, and do you worry about the so-called urban consumption slowdown?
No, I know. I'm very much aware that overall in the industry, the market has been quite bad and the growth has been quite subdued. But the entire set of consideration has a lot of businesses which are not digital. And I think if you have to look at it in digital businesses, the growth has been good. So I personally feel that at Nykaa, we have delivered both great growth as well as profitability. And I think that is very unique to Nykaa. So I can't say that it was I think it was a quarter which is seasonally strong quarter. I think Nykaa has a lot of its strength play out in that quarter. And we also have been focused on a lot of new customer acquisition over last 2-3 quarters. And I think that is playing out well. And also we are using a lot of AI and ML to drive a lot of personalization. And I think that remains a strength that, the e-commerce platforms have.
Falguni, could you give us a sense of your revenue mix from own brands, third-party brands, and the outlook on margins from here on?
Our business is so big, so it is very difficult to share it in that manner. It's a big business and also a complex business. And as you're aware, we have a lot of repeat customers who are constantly buying from the platform, and their engagement continues to be very strong. We disclose that lifetime, we've now acquired about 40 million customers on our platforms, So I think it's very difficult to break it into that. I think we tend to drive it from our own strategy of wanting to balance both new customer as well as a repeat customer growth. I think about a year ago, what we discovered is that in trying to optimize our marketing costs, we were driving more of repeat customer behavior rather than new customer. And I think we consciously changed that over the last 3-4 quarters. And the benefit of that is coming through in terms of much stronger acquisition in our new customer acquisition. However, you can also see that our physical store rollout is also going strong, and that is also giving us further increase in growth momentum. But even in physical retail, even after 210 stores, physical retail accounts for just about 9% of our omni-channel retail sales. So we continue to be predominantly an e-commerce company.
Well, Falguni, what about the sustainable growth path for the BPC business, both on the revenues as well as margins? What kind of trajectory are you seeing out there?
I think we do believe, and we've said so many times, that beauty consumption, it is a very early stage of growth, and what is happening in the ecosystem is only going to accelerate the growth of beauty consumption in the country. And we, as the largest player with all of the channels, we have, we also have eB2B, which distributes to retailers, which is also growing nicely. We have now faster delivery. So with all of we have stores, we have e-commerce, we have our own brands. So with playing in all of the ecosystem, we do want to come out ahead of the industry growth and continue to maintain our lead. So that should give you your answer. But I think we do believe that e-commerce, beauty overall will grow a lot, and within that e-commerce will grow, and so is retail store environment is growing, and we are rolling out a number of stores.
Ms. Nair, now fashion as a category, it started doing really well for you, no doubt about that. But perhaps it's not growing as fast as expected. What is your strategy going to be on this business?
Well, I think on fashion, we are very happy that we are a platform of choice for the consumer, from premium products, high quality and on trend, and we want to stay that, and that's our moat, and we want to continue to build towards that. I think what we've been doing in fashion is adding a lot of exciting brands on the platform. We shared that over the last 2 years, and particularly over last year, we worked very hard to improve the assortment, because I think e-commerce starts with assortment, and people forget that for us, fashion is only a 5-year-old business. And I've been saying for the last 2 years that we're continuing to build the assortment, and more and more better quality assortment is coming on the platform. We're really proud of the fact that, we just launched Snitch. We also launched Victoria's Secret recently. Before that, we had launched Foot Locker, and many other great brands like Calvin Klein and Tommy and others have been launched. So I think we continue to add to the platform a number of D2C brands, domestic brands, international brands. And I think we are in it for the long haul. I think from a profitability perspective, you can already see that our EBITDA loss is only at around 5.6% negative. And you also can see that the marketing cost is at about 30% of our revenues. And I do feel that marketing is something which is controllable. Yes, we couldn't control it in the last year that it went by. I think there were certain experiments on marketing that we tried which didn't work out, and the growth disappeared, and we needed to revive the growth. But we do believe in the long run we should be able to control the marketing costs as the mix of new and repeat customer it keeps improving on the platform, and that is already happening. Like already the platform is more than 70% customers who are repeat and only 30% are new. And as that ratio improves, our marketing costs do come down. And that's our path to profitability for fashion.
All right. Thank you very much for that explanation. Very useful. Now, a little bit about competition, right? Lots of competition around the BPC segment with Tira and others. Now, with Reliance having tied up with Shein, what's your comment on how a competitive landscape is likely to turn out? And what does it mean for a large player, incumbent player like you?
Yeah, I think on the fashion side, Myntra and Ajio are a couple of competition that we are the strongest competitor from a platform perspective. I think what we keep reminding ourselves and everybody is that fashion is a very large business. It is 5 times the size of the beauty and personal care business in India. And it consists of so many sub-segments. So there is like women's Indian wear, women's Western wear, there is men's wear, there is sportswear, there is accessories, there is kids, home. So I think one functions in all of these categories, and there is enough to offer footwear. So there's enough to offer everywhere. And Shein is at best one brand in one category. So I think from a brand perspective, it may be strong, but I think from a platform perspective, there's enough for platforms to do.
All right, Falguni, thanks a lot for stopping by and giving us all of those details with regard to the past quarter's numbers and how you see things pan out from here as well. Well, while we were having that conversation with the management of Nykaa, the markets actually have moved to the low point of the day. The mid-cap index is down again close to 1.5% or thereabouts. So there is consistent selling that we're seeing on the screen. The only good factor, I think, is that the rupee has seen a good recovery. That's it obviously has its benefits, its pros as well as cons, but the rupee actually is at the high point of the day. Yesterday, it had gone down to 87.75, and now it is at around 86.75 or thereabouts. Mitesh is back with us. Mitesh, is it going to be a bit of a down day?
That could be the case, Nine. But again, I think in case we are going to go into some kind of contraction, then this level should hold. 300 280 zone. We're right there. So for them, waiting and watching this stream. But on the stock side, I have a buy on Tech Mahindra and a sell on Tata Power. Sorry. Tech Mahindra is a buy with a stop at 1685 for targets at 1750. And Tata Power, that's on the negative or the sell side. Sell here with a stop at about 356 for targets of 335.
I know something like a Zaggle. I'm just... it's down another 10%. Mitesh, I don't know if you've looked at cash stock, but have you looked at this one ever? It's basically back to levels of, March 24. Yeah.
Not recently, Prashant, but earlier there was some, when the mid-caps were doing well, I was tracking the stock. I think the stock has good support around 350, 340 marks. So maybe around those levels, we'll see the decline come to an arrest. But importantly, I think the medium and the long-term charts with the gap down have been, kind of damaged yesterday and today. So I think on any rallies, if you get the stock closer to about 410, 400 levels, time to exit.
Just some more names, by the way. Look at CRISIL. Stocks are getting completely smashed this morning. CRISIL's down 8.5%. Piramal Pharma is down 6%. And Sirma, these are, the EMS guys end up becoming the perfect whipping boys many a times. It was PG Electroplast yesterday. Sirma this morning is down about 5 to 6%. Mitesh, just quickly on some of these EMS names, they've all come down dramatically from their peaks. Sirma, PG, Dixon. Any advice here, any important levels? Because there would be people who still hold these stocks and they'd be wondering whether to now cash out, book whatever profit remains and just basically exit.
See, I've been tracking only Dixon out of all these stocks because that's the one which is most liquid and in F&O as well. The stock after decline has been consolidating, and 14,500 to about 15,400, 500 is the range. But the structure is still slowly turning more negative. So I suspect a test of 200 average, which is at about 13,510 levels. I think that could be the next target area. So I still believe there's another 1,200, 1,300 points decline possible here.
Look at the capital market plays, right? Look at K Fintech, for example, and that's the problem. I mean, stocks, K Fintech, for example, fell to about 1,050. It bounced to about 1,250, 200 rupee bounce in about 3-4 days. And today it's back to about 1,080, 1,090. Those who are waiting for sharp turns, and you get a bit of a sharp turn, and then you sort of go back and retest those earlier lower levels. I mean, confidence takes a beating, and people will get more and more sort of unwilling to try and, buy as soon as stocks come off a little bit more. I mean, essentially, people would want to wait a little bit more. And that feeling that because if you don't buy here, maybe you're going to miss the bus, I think that goes out of the window. And that's what price action like this does across a wide swath of stocks. And I'm not just talking about K Fintech. There are so many others which had bounced around starting the first, second of this month when the budget had been presented. From those levels, stocks had recovered, and they're all turning back. Not quite to exactly the lows, but close to the lows. They've retraced quite a bit. Well, we'll take a quick commercial break here. We're going to come back, focus on Eicher and ESAF, SFB, that's a small finance bank. They're reacting to numbers as well. Stay tuned, coming up.
Welcome back. Let's focus on some stocks that are catching the attention this morning. And Eicher Motors is definitely one of them. But for the other reasons, stocks been down 5-6%. That margin decline is something that the market is not willing to wrap its head around easily. So Darshan, tell us more. Is that the only reason, or was there anything else missing in the Eicher numbers this time?
So firstly, stock is under pressure. It's down 5% because margin has come in at a 7-quarter low, that is at 24.2%. Now, if you remember, after Q2, for the first time, company had said it would prefer growth over margin. And if you look at over last few months, even in Q3, volumes were up 19% sequentially and year-on-year. Even the last, every month, company has been reporting volumes of more than 90,000 units. So theme is playing out that yes, volume is good. But the question is, what would be the margin level that company would be comfortable with? Because it's a 200 basis points down. It has come at 24.2% versus 26.2% in the same quarter last year. So this is the real question. There would be certain level of margin that company would be comfortable with. Now, what was the reason that margin has come down or slowed? First, weak adverse product mix. Company had recently launched Bullet Battalion. That had helped volume to move higher, but negatively it impacted margin because it's a low margin product. And second, company has been unable to take any price hike over the last few months. So these are certain factors that has been impacting the margin. Yes, company's theme is playing out of growth, but the question is on the margin, and that's the main reason that today you are saying that stock is under pressure.
All right, so thank you very much for that. That's Eicher. It's a big move. ESAF SFB is the next one. Abhishek is here with details. Just to revisit, Abhishek, morning.
Morning, Prashant. So, ESAF SFB is perhaps the only lender to post a second consecutive of net loss. Disbursements are up 42.5% YOY and about 26.6% sequentially. But this has not translated into loan growth. So, loan growth is very weak at about 5.5% YOY and a marginal decline that you can see sequentially. The net interest income is down 18.5% YOY and about 10% sequentially. It's the only lender, amongst all the listed entities, that is banks and SFBs, to see interest income decline both YOY and quarter-on-quarter. So as a resultant, the net interest margin has come under pressure at about 7.9% versus 8.6% in the previous quarter and about 10.6% in the same quarter last year. Provisions that rose sharply. It is up 197% YOY and more than 20% sequentially. So they have reported a net loss of 211 crore versus 190 crore in the previous quarter. Asset quality, that was the pain point. Slippages do remain elevated. Slippages are at 505 crore versus 517 crore in the previous quarter. The annualized slippage ratio is perhaps one of the highest that you are seeing in the banking sector at about 10.5% versus 10.8% in the previous quarter. To maintain the asset quality as per previous quarter's numbers, they have had a huge write-off of about 450 crore in this quarter versus 430 crore in the previous quarter. Back to you.
Okay, got it, Abhishek. Indeed, that's a really high slippage ratio, 10.5% slippage ratio. That's ESAF, Small Finance Bank. Let's quickly move on and talk about some other cues that we're getting in from the commodity markets as well. The India Energy Week has kick-started in New Delhi today with over 120 nations participating in the 4-day event. Our colleague Manisha is standing by with more details on what to expect. Manisha, very sure that all that Mr. Donald Trump is doing will also find its way into the conversations there at this event.
Well, today is the day one of India Energy Week. This is the third edition, and in this third edition by itself, it's become the second largest energy gathering in the world. Especially, this is an opportune time as well, because for 2025, this is the first time that you have various countries, ministers and CEOs gathering together to take a stock of what really is happening globally in sense of tariffs, retaliatory tariffs, the geopolitical tensions, the energy transition, and of course, the energy demand and investment itself. What we do understand that IEW, or the India Energy Week this time around, is looking at participation from 20 foreign ministers from Qatar, UK, Russia, Brazil, etc. There are 90 CEOs present here as well from various energy companies. 70,000 delegates, 700 plus exhibitors are taking part into this. Well, there are also 10 country pavilions here, including US, Canada, Japan, Germany. The day one today is expected to focus on ministerial announcements. Remember, there are various energy ministers from many countries here, so they would be making announcements there. They would be taking stock of what's really happening in the international markets and its impact on energy security. Apart from that, there also is a hydrogen bus ride today. Well, that's a key highlight of the day today. And then there are various MOUs slated to be signed as well. MOUs between BP and ONGC, BP and EIL, Honeywell and AM Green. Honeywell also with NTPC would be signing an MOU. These are some of the few MOUs that I have listed out for you. Apart from that, Minister Puri will be holding bilateral meetings today with energy ministers of Qatar, UK and Russia is some of them. And then there is focus on oil security, on energy transition, energy collaboration, energy resilience, also energy transition capacity and energy digital frontiers. These are some of the topics that are going to be spoken about at India Energy Week today. This is just day one. This is what we have been told to expect from the day today, and plus much more in sense of experience, in sense of AI and experiential stuff that has been put out here. What really comes out is something that I will keep coming back to you with a sense on information on what really has been discussed here.
Okay, so watching out for all the headlines coming in from that high-profile event. Manisha, thank you very much for that. We have to take a break on that note. On the other side, it's time for It's the Economy. Lata will be in conversation with Niti Aayog member Ramesh Chand on the impact of the budget and the tariffs on Indian agriculture.
Welcome back. Today on It's the Economy, we focus on agriculture. The budget didn't actually increase the total allocation to the Agriculture Ministry. It actually fell by about 2.5%. But the government announced a bunch of technical missions like Mission for Pulses, Atmanirbharta in Pulses actually, a mission for cotton, mission for high-yielding variety seeds, and even for fruit and vegetables. Separately, now another issue, the Reserve Bank cut rates, betting that food inflation is headed lower in the months ahead. And a third separate issue, the United States is forcing India to reduce its tariffs, and that brings the question on whether India will have to bring down tariffs on even products like milk, fruit, vegetable, and thus endanger rural India or several sections of rural India. For all these variety of questions, I have with me India's foremost agriculture expert, Professor Ramesh Chand, member of the Niti Aayog. Dr. Chand, thank you very much indeed for joining us. I know I've stuffed in too many questions, but let me start first with this tariff issue. I mean, it is only now that I did any research on what are the tariffs we impose on US vegetables, on US frozen seafood, meat, milk and milk products, 30 to 40%. Do you think we are in danger of having to bring all this down to 10%? And will that mean we are going to endanger a lot of Indian semi-rural industries?
I will not say we are in danger. We have enough capacity in agriculture to make it more competitive and to compete with imports which are qualitatively different, which have some advantage in terms of price. Just to give you one example, I was in USA in the month end December, and I found Amul milk selling at a premium price in US store. So if our Amul milk can compete with the milk that is produced in USA, that indicates something that why we should be afraid of low price milk coming through import into the country. There are several examples like this, where whenever we were exposed to competition, Indian agriculture stood up to the challenge. And in the short run, there were some problems, but after some time, we became more competitive. Another example is when under WTO, we were required to open up our market. Initially, there was some setback, but after that, you just find our share in global trade, global export for most of the commodities and for total food has increased. So Indian agriculture has enough capacity to improve efficiency, both in production, in logistics, in marketing, to stand up to this 5 or 10% reduction in tariff.
Okay, so especially milk and milk products, which is a very large industry. I think we are either the largest or the second largest producer in the world. And in fruit, you would not worry that our farmers will be hurt.
You see, there are contradictory indicators in case of milk. If you look at OECD report, it just says that Indian farmer is net taxed as far as milk and dairy products are concerned. If that is the case,
really?
It speaks that our prices are lower than what our international price, and we should not be unnecessarily be afraid of this competition to dairy kind of thing. Okay. If you compare quality by quality, then you just find that we are competitive. Sometimes we start comparing products which are qualitatively different, and problem comes there. If you compare product of same quality, you just find that we are competitive. And I gave you example of Amul, that yes. Amul selling in US market, not in small quantity. Just find it selling in large volume in Costco in US stores.
Okay. So, no, that's very encouraging, sir. Coming from you, I mean, I would take it, very optimistically. Let me come to the next question. The Reserve Bank is betting. The rate cut has come primarily, it is not a core inflation problem at all. That has been under 4%. It has been largely food, which has been the inflation rising between 8 and 11% over the last 18 months. December was the first month when we saw it recede. Are you confident that 2025 we will be in mid-single digits or low single digits on food inflation?
I recall that on your channel in the month of December, I just said that by March, the food inflation will come down significantly, but it has happened much before that. In fact, my own take on food inflation in the month of January is that it will be below 5%. So I think those months of high food inflation are now over. For a couple of months after next year situation, what kind of situation emerges cannot be said with confidence right now. But as far as next 3 months are concerned, you will find the number for month of January. You will see that inflation has already come to the comfortable zone. Not only single digit, I will say it will be half of the lowest double digit.
Oh, that is excellent, sir. You feel confident about up until March. You are saying that for the latter part...
Up to April, up to this...
yeah, I get it. After that, you are worrying. You would say that it will depend on the monsoon. Is that why you're not committing?
I'm not worried. I can't say anything with certainty as of now. Some more variable need to be considered. International situation, what kind of forecast for monsoon comes, those kind of things. But indicators are available to say something with confidence up to month of April.
Okay, that's extremely helpful. Two of the most burning issues, you have given us some peace of mind: tariffs and interest rates. Now let me come to the budget. So the budget announced very correct technical missions. There was for pulses, for cotton, for high-yielding variety seeds, and there was also a program announced for fruit and vegetable. But I didn't see any amount being announced. If you looked at the Agriculture Ministry, and the allocation is coming up on the screen, for agriculture research, the increase in the funding was only by 3% to 10,466 crores. For the entire ministry, the total allocation has gone down from 1.41 lakh crore to 1.37 lakh crore. So, where does this confidence of running these various missions come?
See, in allocation of budget, many times you put figure based on what is RE for the previous years. But those kind of expenditure, two type of expenditure. One is which are committed, that even if figure go very high, you are going to increase it. So I just looked at the individual figures. One reduction happened in case of insurance. So if the expectation is that we are going to have normal kind of Rabi season, there will not be requirement for paying much as a insurance. So it makes sense to lower the allocation for those kind of items. But those kind of items are open-ended. If the situation requires that it requires, say, 15,000 crore or 20,000 crore, government has to pay it. The flexibility is there only in terms of, say, making rural roads, that after your budget is exhausted, you don't do it. But if you are committed to say that we will give subsidy on urea, and a bag of urea will be sold for 270 rupees, even if the amount increases significantly, government is bound to achieve that. So I think we should not read too much from these budgetary figures.
Allocation.
Regarding your question that these
vegetables in particular.
You see, by this focus on first this, let me say, fruit and vegetable, if you look at the past 10 years, you find that the growth of fruit and vegetable is almost 3 times the growth rate of output of field crops. Field crop means cereal, oilseed, pulses, cotton.
Yes.
But we found that horticulture is done just on about 7% area, and large number of farmers do not do horticulture. So we suggested to government, and I'm happy it has been accepted, that we need to slightly change the focus of our mission integrated development of horticulture, rather than spending on horticulture on the existing household. We should bring more and more farmer under the fold of horticulture. So we should take horticulture to more farmer and extension in terms of supply of quality plants which are free from disease, etc., good quality kind of things. So that is the reason to put emphasis on horticulture, that number one, horticulture growth is 3 times the growth rate of other crops, and it is driving the overall growth rate of horticulture. And secondly, some of the field crop, the growth is low. We want those farmers also to put some area under horticulture. So if they diversify little bit, even if they put, say, 10% of their area under horticulture, the income can increase by 50 to 60%. That is the kind of power of horticulture, that productivity of fruit and vegetable for India as a whole is about 6 times the productivity of field crops. So this is the reason that emphasis has been given. And another reason is that this latest survey on consumer expenditure, which is now available, you find that direct intake of cereal is either not increasing or it is falling. But if you look at fruit and vegetable, among all expenditure class, even bottom 10%, you find that intake of fruit is increasing. So because of these reasons, that scope from prospect from supply side and demand shifting significantly in favor of horticulture crop, the emphasis has been laid on fruit and vegetable.
Okay. So unfortunately out of time, but I'll take a rain check from you for a more detailed discussion on the budgetary proposals. We did not understand it with this depth and color at all. It requires a much more detailed explanation. Unfortunately, at this point in time, we're all worried about why the rupee has strengthened from 88 to $1. Today, right now, it is 86.6 or thereabouts. So it's been a sharp increase. There are other pressures on us, but we will come back to you for a detailed discussion. Thank you very much for your time. We have to wrap up on Bazaar. On that note, Chartbusters coming up.